Another important development has been the cutting of deposit rates by several banks. It started off with SBI, and we now know that quietly HDFC Bank and ICICI Bank have also cut rates starting December 1. An important person from the banking sector joins us, Rajat Monga, Chief Financial Officer and Senior Group President Financial Markets at Yes Bank. Rajat, a spate of deposit cuts have come. Will you all be following suit? And more importantly, when does this translate to a lending rate cut?
Yes, I think what we're seeing is banks are adjusting as of now for, if I may say, the illiquidity that used to be priced in various short-term money market pricing for interest rates. I mean, as we are seeing more and more that the central bank is getting more and more comfortable with the tools that they have to manage liquidity. Naturally, the bias for interest rates is also looking gradually lower. So my assessment is what banks have done of late, even other markets, you can call it bond markets, have done is to strip off the illiquidity premium that usually gets priced in. When you're not too sure whether we'll get financing at what rate, will we get repo at what rate. So there were periods of choppiness, so that just gets priced in the asset that we are holding. So this is what we are seeing. Banks are beginning to adjust to the...
So basically you're saying there used to be an interbank deficit of about 80,000 crores. Now that deficit on an average is 40,000 crores. True. And that has created discomfort on liquidity.
Absolutely. 6 months ago, the deficit was looking widening. Today, the deficit is looking that it will narrow. Reserve Bank has, about $40 billion of long forwards. The moment they expire those forwards, it creates rupee liquidity. So if you look at the repo rate, it's been at around 8 for a long while. Banks have been pricing one-year deposits at 9. They have just dropped that to about 875 range over the last few weeks. Not yet. I'm assuming we will follow suit. I think it's just that the deposit pricing starts with the large banks. I mean, we can't have a lower pricing when SBI or other large banks have higher pricing, for example. So this process has begun. I think most banks will progressively adjust lower. So it is. I will still, if you still look at repo at 8, one-year deposit at 875, there still is a decent sort of inclination on that yield curve. So there is room for liquidity itself to drive rates lower yet in the future.
So when do you see the first lending rate cut come in?
Lending rate cuts are a little bit of I would say, a function of when risk appetite comes back into the banking sector. Banks will drop rates and when they begin to believe that this is the time now to lend and that they have resources, rates have fallen, and we want to transmit rates to grow credit.
What do you mean by saying when risk appetite returns? Is it when more people come and ask for money, or is it that you get a hunch that your money is safe?
Well, the latter more than the former, and actually they usually come together. People, let's say if we just roll back a few months, a couple of years, while there was demand for money, but there was not demand for fresh money. It was demand for refinancing, effectively lengthening of debt profile by borrowers. Now the demand will have to shift to groundbreaking work, capacity expansion.
You don't see any of it yet?
Well, there are signs. Let me say, not good enough to alter the trajectory of outcomes that we are currently witnessing. But there is clearly there is new business which is being discussed, which relates to capacity expansion. What we are not seeing is the working capital sort of expanding because of companies producing more. We are seeing working capital expanding because some companies might still be making losses. Okay. So you still have to fund the cash flow deficits that the businesses are aggregating. So I think the overall situation is mildly positive on that side, but not clearly positive that we want to believe that credit growth is the best thing to do right now.
The big change we've seen in the last couple of days is the way yields have fallen to sub 8%. What could the positive impact be on your own corporate bond portfolio?
Well, corporate bond portfolio is naturally is a long portfolio, so it will benefit from the overall yield structure falling. So we are overall positive on that sort of outcome. Bond portfolio is more a distribution design that we are holding, and as we distribute these holdings, there will be realization of some gains as well. There is also, not just us, all banks also hold government debt as SLR. For example, we have a reasonably peakish holding under the held to maturity category. We will also be monetizing the held to maturity category, as now RBI will require banks to reduce their HTM. So currently HTM proportion is higher than SLR proportion. So
that's from 24 to 22.
Yes, so there is duration in the HTM book which we will naturally monetize, and the idea is that if there are gains, we should also use them to buffer up provisioning. So take more countercyclical provisioning. Like today we have about 50 basis points of more than required provisioning. We can call that countercyclical provisioning.
Okay.
So if we get such opportunities, we will try and buffer that up.
Rajat, how much will margins go up for you? Because you'll have a double gain. I mean, you will have lower cost of money from the wholesale markets, as well you will have a decent amount of mark-to-market gains.
Yes, I think on the margin front, I think the situation will pan out depending upon how the asset liability markets behave. We don't have gaps as such. So there is, yes, like we were discussing, the illiquidity premium. So the larger bulk deposits do attract more illiquidity premium when times are such.
And they have fallen now.
Clearly. So today, let's say if we don't drop our retail rates are higher than bulk rates at the moment. That's also a precursor of retail rates to be falling off. So these are all consistent sort of precursors. So it's only a matter of time that retail rates will also be lowered commensurately.
The last NIM was 3.2.
That's right.
Okay, second quarter. Clearly it's on an incline for Q3.
I wouldn't say, see, the incline is there. Let's say, I mean, quarter-on-quarter incline is something even I will not be able to clearly establish. There is a...
Your costs have clearly fallen.
Well, yields also fall. Like, for example, we were discussing the bond portfolio. The moment we monetize some bond portfolio, we were holding a higher yielding asset. We will be replacing it, if at all, with a lower yielding asset or not.
Can you tell us how much of your bond portfolio is hedged at this point? And can you give us some assumption on, you know, every 100 basis points decline, how much could it impact your profits, etc.? Any ballpark figures?
Well, let's say on the first part, the corporate bond portfolio is not hedged. There will be some part of the government bond portfolio which is hedged. So naturally, the gains which are there and those are more gains designed for, let's say look, if you look at the markets today, the 5-year bond is at about roughly 8. The 5-year OIS is at roughly 7. I'm just approximating. So why not buy a 5-year bond and pay a 5-year OIS. So over a period of 5 years, you have a 1% locked-in gain. So these are the hedges that you can sort of also look at, more spread sort of opportunities than outright trading. So on the impact on the profitability, I think it's just I would say too early to begin to reckon. If you ask me, do I know what the gains in the portfolio is? No, we have not tallied that requirement, because we know when we have gains, we will buffer up a little bit on the provisioning side, which is good long-term opportunity, because this is a cyclical sort of consequence. The rates fall when the cycle is weak. All banks hold mark-to-market positions because of
one final correlation I want from you.
Of course.
When is there a correlation between the fall in rates and the improvement or peaking off of NPLs? Can you say that a 0.5% fall in yields or a 1 percentage point fall in the 10-year yield marks the end of NPL increase, or actually a fall in NPLs?
Okay, let me say the fall or the increase in, not NPAs, if I may say, stressed assets has already been marked.
Okay, fine.
So NPLs is decrease in NPLs, therefore, will be a function of when recovery stacks up. Now that is away in terms of time. So the fact that stressed assets may not be increasing has already been well marked. That's because the fact that rates are falling or going to fall, all of these are supportive forces for NPAs, or rather stressed assets not increasing. I think there are two parts of stress that you see mostly in a borrowing situation, either an operating level stress or a financial level stress. Now rates can help a financial stress, not a 10-year bond yield, but banks dropping their base rates, which is yet to happen. There is the operating level stress, which can be affected more by the growth opportunities, essentially how is the GDP panning out in the respective sectors, so that can help the operating line. I think both are on the cusp of getting better. So I wouldn't say that, maybe there is a correlation, yes, but not a cause and effect of rates falling and NPAs kind of reducing.
Okay, so you can place a base rate cut before the financial year ends.
Well, if RBI cuts rates, I think I'm more confident. Otherwise, this is just, banks may not even have passed on the illiquidity sort of premium to borrowers, and this is just being revoked effectively from the pricing structures.
All right. We'll leave it at that, Rajat Monga. Pleasure speaking with you. Thank you very much for dropping in
Thank
today.
you.